Balancing and diversifying portfolios, managing risk and maximizing returns. Introduction. This video explores how to manage investment risk while working towards consistent financial returns. Whether you're investing in Kenya, across East Africa, or in global markets like the US, Europe, or Asia, the core principles of portfolio management remain the same. Let's dive into what a portfolio is, how to balance it, and why diversification is essential for financial success. Understanding a portfolio. A portfolio refers to the collection of all your investments. This may include stocks, bonds, real estate, mutual funds, and even cash holdings. For example, a Kenyan investor might hold shares in Safaricom, government bonds from CBK, and a piece of real estate in Nairobi. Internationally, an investor may have Apple shares, US Treasury bonds, and a European ETF. What asset allocation means? Asset allocation refers to how you divide your investments among various asset classes. Common asset classes include equities, stocks, fixed income, bonds, cash or cash equivalents, real estate. The way you allocate affects both the risk and potential return of your portfolio. For instance, a younger investor in Kenya might allocate 70% to stocks and 30% to bonds, while a retiree might reverse that ratio. What diversification is? Diversification means spreading your investments across different areas to reduce risk. Within each asset class, invest in multiple options. For example, different types of stocks, tech, energy, banks. Various bond durations, short, medium, long-term. A diversified Kenyan portfolio might include Safaricom, KCB Bank, and British American Tobacco. An international version might combine Microsoft, Toyota, and Nestle. Importance of balancing. Balancing is the process of reviewing and adjusting your portfolio to stay aligned with your goals. Over time, certain investments may grow faster than others, changing your overall risk exposure. For example, if your stock holdings outperform and now make up 80% of your portfolio, rebalancing helps restore it to your original 60% target. Importance of diversification. Diversification reduces risk by ensuring no single investment dominates your portfolio. If one investment drops in value, others can cushion the impact. For example, if Kenyan agricultural stocks decline, tech or banking stocks may hold firm. If global oil prices fall, non-energy stocks in your international portfolio may compensate. Risk and return relationship. There's a direct relationship between risk and potential return. Higher risk may offer higher returns but also greater chance of loss. Finding your personal balance between risk and return is key. A Nairobi-based entrepreneur may take more risks, while a retiree in Kisumu may choose more conservative investments. Aligning allocation with goals. Your asset allocation must reflect your financial goals and timeline. Short-term goals need safer, more liquid assets. Long-term goals allow room for higher risk, higher return investments. For instance, saving for a house in 3 years? Use bonds and money markets. Investing for your child's university in 15 years? Consider growth stocks and real estate. Example asset allocations. Here's how portfolios might be structured based on risk appetite. Conservative, 20% stocks, 50% bonds, 30% cash. Moderate, 50% stocks, 30% bonds, 20% real estate. Aggressive, 70% stocks, 20% real estate, 10% cash. A Kenyan moderate portfolio might include Nairobi Securities Exchange ETFs, treasury bonds, and rental property in Kisumu. An international version might include S&P 500 ETFs, global bonds, and REITs. Diversifying within each asset class. It's not enough to own just one type of stock or bond. Diversify within the class. Multiple sectors, tech, agriculture, financial services. Multiple regions: East Africa, West Africa, global markets. Example: stocks, Serrari Equity Group, East African breweries. Bonds, Kenyan infrastructure bonds, World Bank bonds. How to rebalance. Rebalancing means periodically reviewing your portfolio. It helps bring your asset mix back in line with your target. Let's say your stocks outperform and become 80% of your portfolio, though your target was 60%, you'd sell some stocks and buy bonds to restore balance. Do this quarterly, semi-annually, or annually depending on your investment strategy. How to diversify. Diversify by spreading investments across different asset classes, stocks, bonds, real estate. Investing within each class in a range of options. Covering different industries like telecom, energy, retail. Choosing investments in varied geographic regions. Kenyan example: Equity Bank shares, Nairobi rental property, CBK infrastructure bonds. International example: Google shares, US REITs, emerging market ETFs. Benefits of balancing and diversifying. Minimizes the impact of market volatility. Provides more consistent returns over time. Increases the likelihood of reaching long-term financial goals. Offers peace of mind knowing your portfolio isn't overly exposed to any single investment. Key takeaways. Balancing and diversification are essential for smart investing. Asset allocation should reflect your goals, risk tolerance, and time horizon. Regularly rebalancing keeps your portfolio on track. Diversification shields your investments from isolated downturns. A well-managed portfolio can help you stay calm during market changes. Conclusion. Thank you for watching. Whether you're an investor in Nairobi, Mombasa, or New York, remember, a balanced and diversified portfolio is your best defense against market uncertainty. Invest wisely, review regularly, and align your choices with your long-term goals.